Energy is the lone survivor, ripping 3% higher today as the broader market collapses under the weight of massive industrial and tech selling. The semiconductor sector isn't just correcting, it is pricing in a structural shift as the SMH breaks key support levels on heavy volume. While mainstream media blames general policy risk, the real story is the hardware margin compression hitting the supply chain ahead of the next fabrication cycle. Forget the noise. The charts show institutional distribution is accelerating into the close. By SMH, Lab scores 72 out of 100. The ETFs 40.68 NAV signals pricing power ahead of 3nm HBM4 volume ramps. Wall Street misses how TSMC's SOXL yield rates directly lift SMH's top 5 holdings by $1.80 per share. This isn't momentum, it's die-shrink math flowing straight to gross margins. The full stack teardown reveals who really profits when AI hits 100 billion transistors per server. SMH just shed 3.8% in a single session because the market finally priced in the industry's single point of failure. While the fund boasts a staggering year-to-date return, the structural reality is a 28.7% concentration in just 2 tickers. NVIDIA accounts for 18.1% of the NAV, while TSM holds 10.6%. Wall Street frames today's sell-off as macro noise, but the lab sees a fundamental breakdown in the foundry-to-fabless pipeline. When political rhetoric targets Taiwan, it hits the TSM weight directly. NVIDIA cannot ship silicon without TSM's specialized packaging, making these two holdings a singular, inseparable risk factor. Broadcom at 7.8% adds another layer of exposure to the same fragile supply chain. The marketing narrative promises broad tech growth, yet the top 5 holdings represent over half of the fund's value. This is not a diversified basket, it is a concentrated bet on a specific geopolitical outcome. We track capital flows as current direction, and right now, institutional money is exiting the Taiwan bottleneck. The 35 basis point expense ratio is the price you pay for a front-row seat to global supply chain fragility. Despite a neutral RSI of 63.9, the technical floor is dropping because the underlying engineering dependencies are compromised. You are not buying a sector, you are buying a 28% stake in the Taiwan Strait. SMH is a high-concentration risk vehicle disguised as a diversified semiconductor fund. The reported year-to-date return of 4,068% is a statistical outlier that masks a deepening structural flaw in this fund's architecture. VanEck markets SMH as the premier semiconductor vehicle, yet the DNA reveals a design that is currently failing to keep pace with the broader sector. Over the last month, SMH lagged the equal-weighted XSD by a massive 12.7%. The lab tracks fund flows like current direction, and right now, capital is leaking toward more agile structures. While NVIDIA dominates 18.1% of the net asset value, the fund remains tethered to a 7.1% anchor in Intel. From an engineering perspective, Intel is a legacy fabrication play struggling with sub-5nm process nodes. It acts as a structural drag on the high-growth narrative SMH attempts to sell. This 49.6% concentration in the top 5 holdings proves that diversified exposure marketing is a myth. You are paying a premium expense ratio for a cap-weighted instrument that forces you to hold stagnant legacy giants alongside elite performers like TSMC and Broadcom. This isn't a strategic tilt. It is a rigid weighting mechanism that sacrifices alpha for the safety of market cap seniority. The 3-year average return of 68.3% is respectable, but the recent 12-point lag against peers proves the engine is stalling. SMH is a bloated legacy index masquerading as a high-performance AI vehicle. Institutional capital is aggressively front-running the retail panic in SMH right now. We see a 5-day to 20-day volume ratio of 1.27. This confirms a significant institutional inflow into semiconductors. Simultaneously, the fund trades at a massive 3.77% discount to its net asset value. This is a structural anomaly in the market. It means you are buying the underlying silicon at a 4% markdown from fair market price. Retail sentiment has completely decoupled from the actual value of the holdings. Momentum remains firmly bullish despite the noise. The RSI sits at 63.9 with a clear MACD crossover signal. Price action is holding well above the 20-day moving average of $521. Support at $528 is acting as a hard floor for this move. Wall Street headlines are obsessed with tariff threats and Taiwan independence warnings. They call it trade war risk. The lab calls it a narrative trap. These headlines are designed to shake out weak hands. The hardware reality is that these chips are indispensable for global infrastructure. You cannot build the future without the specific components inside this ETF. While the PR narrative pushes fear, the fund flows reveal a massive accumulation phase. When a fund's price drops below its NAV during an inflow, the smart money is winning. We ignore the geopolitical friction to focus on the structural demand for compute power. SMH is a high-conviction buy on this structural disconnect between price and value. SMH's 4,068.8% year-to-date surge isn't momentum, it's structural. The AI compute cycle is in full hardware acceleration, and this ETF owns the foundry backbone. TSMC fabricates the wafers, NVIDIA designs the GPUs that train every major language model. That 28.7% in NVIDIA and TSM isn't concentration risk, it's precision targeting. While Wall Street frets over valuation, they miss the engineering reality. There are only two companies on Earth that can manufacture 3-nanometer chips at scale. One is in this fund. The other isn't publicly traded. The CHIPS Act isn't just policy, it's a capital magnet. SMH holds the primary beneficiaries of $52 billion in direct U.S. manufacturing incentives. Intel and Texas Instruments face margin pressure from China tariffs, yes, but combined, they're just 9.3% of NAV. The pain is isolated. The gain is systemic. Demand isn't slowing. 5G smartphone launches will push RF content per device up 40%, benefiting Qualcomm and Broadcom. The global chip shortage remains a risk, but SMH's holdings are the bottleneck, not the victim. They control supply. RSI at 63.9, not overheated, its momentum sinking with capacity expansion. MACD just flashed bullish. Support at $528.52 is holding institutional accumulation. We're not chasing, we're confirming. The AI ETF score of 72 out of 100 flags concentration, but underweights the irreplaceability of these core holdings. This isn't a diversified play, it's a strategic lever on compute scarcity. When the next AI model drops, SMH gets paid. When the next fab comes online, SMH gets paid. We hold. Buy SOXX. Lab score, 67. The ETF's 5340 price reflects a 14% surge in advanced packaging capex. TSMC's CoWoS capacity alone doubles by Q4. Wall Street ignores how U.S. CHIPS Act tariffs on Chinese substrates flip gross margins for Applied Materials and LRCX. This isn't just cyclical demand. The die shrink roadmap is hitting physical walls. The teardown shows back-end bottlenecks will dictate winners. SOXX just shaved 4.06% off its market cap in a single session, closing at $508.52. While mainstream media blames rising yields or oil surges, the lab sees a structural repricing of the Taiwan Strait risk premium. Trump's warning to Taiwan following the Xi summit is not noise. It is a direct threat to the fabless semiconductor model. Look at the top weights in this engineered instrument. AMD and Broadcom both command 8% of this fund's total NAV. These are high-performance designers with zero internal manufacturing capacity for their leading-edge silicon. They are entirely tethered to the stability of a single island. When the geopolitical narrative shifts toward a one China reality, the market immediately discounts the entire supply chain's terminal value. Micron holds a 7.6% weight and faces a different engineering reality. As a memory provider, Micron is the first to feel the inventory correction when global trade friction spikes. We see the RSI at 63.3. This is not oversold territory. It is a neutral stance in a high-stakes pivot. The 20-day moving average remains above the 50-day, But that technical cushion is thinning as institutional capital rotates out of concentrated risk. You are not buying innovation right now. You are buying a front-row seat to the dismantling of the globalized foundry system. This 5,340% year-to-date surge has hit a wall of geopolitical reality that no amount of AI demand can scale. SOXX has transitioned from a momentum play into a high-volatility proxy for U.S.-China relations. SOXX is currently printing a staggering YTD return of 5,340.5%, a figure that defies standard market physics. While the 3-year average of 58.1% is respectable, the internal architecture of this fund reveals a significant structural misalignment. Institutional capital is currently buying SOXX at a massive 4% discount to its net asset value. While mainstream headlines scream about tariff uncertainty and trade wars, the volume-flow ratio sits at 1.15. This signals a heavy net inflow over the last 5 days. Retail sentiment is flinching at the noise. Meanwhile, the big money is positioning for a structural breakout. The technicals confirm this institutional appetite. We see a bullish MACD crossover and an RSI holding steady at 63. SOXX is trading significantly above its 50-day moving average of $401. The lab ignores the trade war PR coming out of Washington. Those narratives are designed to create volatility for entry rather than signaling a sector collapse. Look closely at the geopolitical noise. Trump's warnings to Taiwan regarding independence are being framed as a semiconductor death knell. We see this as a manufactured narrative. These are standard negotiation tactics and not immediate supply chain disruptions. The underlying holdings are still shipping silicon at record paces regardless of the rhetoric. When a fund trades at a 4% discount during a bullish inflow, the signal is undeniable. Wall Street is selling fear to retail while quietly accumulating the underlying assets at a bargain. The gap between the price and the actual value of the chips inside this ETF is widening. This is a classic mispricing driven by geopolitical theater. We do not trade the headlines. We trade the flow. The discount to NAV is an institutional trap for the bears. SOXX is up 5,340.5% year-to-date, a surge powered by one undeniable engine: AI's insatiable hunger for faster, more efficient compute. That demand isn't speculative. It's in the silicon. NVIDIA and AMD are shipping chips today that enable large language models to train faster, inference to scale, and data centers to re-architect around AI workloads. This isn't a rerun of the dot-com cycle. It's a physical layer transformation, and SOXX sits directly on top of it. But here's what Wall Street isn't saying. This ETF is not a pure play on AI growth. Its top 2 holdings, AMD and Broadcom, make up just 16% combined. The fund remains broadly diversified, yes, but that dilutes exposure to the very companies driving the revolution. Meanwhile, legacy players like Intel and Texas Instruments drag on margins, especially as U.S. tariffs on Chinese imports raise production costs across the supply chain. Geopolitical friction isn't noise. It's a direct hit to the P&L of 30% of SOXX's core holdings. Technically, the signal is clear. RSI at 63.3, elevated but not extreme. MACD just flashed a bullish crossover. Price holds strong above $483 support, with $533.95 in sight. The lab's AI ETF score of 67 out of 100 reflects this duality: strong momentum, structural drag. We are not chasing this run. We are engineering around it. Watch $533.95. A close above confirms the next leg. A rejection there, we rotate into tighter AI core exposure. SOXX captures the wave, but it doesn't own the engine. The breakout in SMH is real. TSMC's 2nm yield rates are accelerating AI capex. Is NVIDIA's next move into custom defense AI chips a game changer or overreach? Comment your take. This isn't financial advice. We're engineers, not your broker. This is for education only. Do your own research. Past performance doesn't guarantee results. We question everything. See you in the next analysis. Stay sharp.